Hi, I'm Tahn Sharpe. Welcome to the Inside Network. Welcome to the Inside Network. With us today to discuss high conviction investing is Claremont Global Head and Co-Portfolio Manager, Bob Desmond. Bob, thanks for joining us.
Morning, Tahn. Good to be on.
Can you set the table for us by maybe explaining the value proposition of quality and high conviction investing?
The way we think about it is, if you actually look at our website, we actually say own the world's best businesses. And there's two key words in there. One is own, and the other one is business. We don't trade markets. We don't trade stocks. So if you can change your mind mentally to think about owning businesses, obviously, if you were a business owner and you had your own businesses, you would want to own, the best businesses you could, and you'd want to concentrate all your capital in those businesses. I've never understood why you would want to take capital from your best business to give to your less favored business on a short-term basis. So there are only a few select businesses that meet our criteria, and we like to concentrate our capital in that. There's another advantage to being concentrated, is it frees up a lot of time. So we don't spend a lot of time thinking about macro, about what's the latest trend or what's the latest theme. Most of our time is just spent getting to know our businesses better, obviously understanding their competition, the industry, the people who run it. And it just frees up a lot of time and allows you to be focused on those companies rather than flitting from flower to flower.
Do you set any specific parameters on the type of companies that you invest in?
We're pretty strict on that because obviously if you've got a very focused portfolio, each company has to be very resilient in its own right. You can't have a little bit of this and a little bit of that and let's hope that works out and let's put a little bit there. So a couple of key things. We don't make macroeconomic forecasts. So the first thing, they have to be very resilient in downturns. So that's the first thing we always look at in the business. How did that business go through the GFC? It's about as tough a test as I've seen in my career. So they want to have resilient earnings, good balance sheets, high margins. So that's the first thing. We want resilient businesses because it's so concentrated. But then the second thing we're looking for is we want businesses that are quite simple to understand. I don't like complexity. I don't like spending all my day trying to understand a phase 3 drug trial or who's going to win the US election. What does that mean for Medicare pricing? Or trying to make a macroeconomic forecast. What does that mean for interest rates? Or economic forecast, what that means for commodity prices, or spending my days analyzing a really complicated bank balance sheet, for example. So we exclude anything leveraged, banks, anything commoditized, oils, resources, etc. Anything complex, so pharmaceuticals, biotech, and then anything regulated, so utilities. So once you strip, and anything cyclical, low margin type businesses, we just strip all of those out. And so what we get left with a subset of about 150 companies globally. And we're not looking, unlike most fund managers, I think we're not looking for the next new thing. We're looking for the proven industries that are proven over long periods of time. So the average business that we own is over 80 years old. And we just focus on that subset of companies.
And with those 150 companies that you may be looking at, are they sector specific in any way, or do they lend themselves to being in any particular sector?
We don't define sectors. It's more the second point. They lend themselves to certain sectors. So we really like financial plumbing businesses. So we don't like banks and the leverage, but we like businesses that are integral to the whole financial system. So something like Visa, for example. We like parts of tech, what I call easy tech or tech staples, generally B2B business models. They're essential to businesses running, their operations. So something like, a Google, something like a Microsoft or Adobe. We're not looking for, the next Tesla or that type of thing. So in tech, it's basically really resilient businesses, long track records, high margins, predictable earnings. Industrials, we generally stay clear of cyclical industrials, but we look for niche industrials, things that are high margin, high gross margin, generally sold what we call a white coat sale. Right. So an expert selling to another expert. We like that. We wouldn't buy a Caterpillar or Deere because it's very kind of cyclical. We have to make a macroeconomic forecast. Healthcare, we stay away from things like biotech, pharmaceuticals, but we love things that are simple to understand. The growth drivers are good in healthcare. So we own a hospital sterilization business. We own a animal healthcare business, because animal healthcare is much simpler than human healthcare. So those types of things. Business services. So we have in the past owned insurance brokers. We're not talking home and contents here. We're talking about all the needs that a Fortune 1000 company would have. It could be cyber risk. It could be, director's risk. It could be, insuring offshore oil rigs, or, complicated risks, those types of things. And I think that's, those are all areas, where we would be. And we like brands as well. So we've, owned things like, and we do own LVMH or Nike or something like that.
Sure.
And that's pretty much where we've always been.
So having a concentrated number of stocks, I think you hold between 10 and 15 at any one time. Even though it's a small number of stocks, you focus on high quality companies. So I guess that actually lessens risks in portfolios. Is that fair to say?
I mean, obviously the normal definition would be the less stocks you have, the more risky the portfolio. I mean, I think the way I think about it, and I can give you some stats which would maybe suggest that, but I don't want to be taught my own book here. But I think if you understand a business really well and you understand that industry and it's slow changing, I think a lot of risk comes from not knowing what you don't know, in a way. So making sure you're, in the words of Warren Buffett, sticking within that circle of competence and knowing where that kind of boundary is, I think is really, really crucial. So buying simple businesses that change slowly, that have predictable earnings, that have resilient earnings. You can't have a 10 to 15 stock portfolio where you're kind of what I call throwing darts or taking binary bets. I'm taking a bet on a commodity price or an interest rate or an economic outcome or a drug outcome. You just can't do that in a 10 to 15 stock portfolio.
Claremont Global has recently added an ETF version of its $1.4 billion global equity fund. Can you speak to that move and the addition to the product suite?
It's really just, investor trends are changing, especially among some of the younger generation. People want to do it direct rather than through an advisor. There's been demand from clients. When we approach them, they say, we don't really like it if you have a listed ETF. There are advantages to a listed ETF. There's less admin. So if I'm already signed up on the ASX, I can just go and buy it on the ASX. So much less paperwork. A lot of people just like more trading type clients rather as opposed to asset management clients. The younger generation, there's obviously a big transfer of wealth coming in the next decade. So it's really in response to demand from clients. We have taken our time about doing it, but more and more when we see clients say like, "Oh, we'd really like it if you have a listed ETF." So I think it appeals to people for all those reasons.
How does it work operationally? I mean, when you take a managed fund and then turn it into an ETF or spin out an ETF version of that, how do you manage the portfolio section of that ETF?
It's managed exactly the same. So that the weights and everything is exactly the same. So it's not a different strategy. It's exactly the same companies, same weights. So it's, and the two products are interchangeable.
Where do you see Claremont Global being in 5 years? I mean, is it a matter of just growing the global fund, both the hedge and unhedged version, and the new ETFs, or is there a higher purpose in mind?
Higher purpose. No, I think where we've been the last 5 years, I think is we want to get good risk-adjusted outcomes for clients. That's number one. We want them to understand the investment approach. We want to have really, really good relations with them and really clear communication and try and be as transparent as possible. And where we think the fund's good value, we'll tell them. Where it's less good value, we'll tell them that too. We're pretty transparent about all our mistakes, all our holdings. So you can see sometimes I think it's more important to be transparent with the mistakes, and hopefully the upside takes care of itself. And then over 5 years, obviously we want to grow it. It's a business, we want to grow it. Long term, we have said, this is a nice problem to have in the future, but we will cap the fund at $7 to $10 billion. We're a long way away from that, but we don't want to be, a big mega fund because we think it just gets harder to get those returns and harder to get give clients the service they expect.
Wonderful. It's been a pleasure. Bob Desmond, thanks for joining us at the Inside Network.
Thanks, Tahn.